Okay, so someone asked us, do you have any resources that send us explanations exactly how to declare the CRA, the interest for tax deductions? And they're looking for an accountant in Quebec. So Rob, I'll let you touch that one real quick, I guess, for the Quebec side.
Yeah, we're training up Smith Manoeuvre certified professionals from coast to coast, and that includes Quebec. We've got about 80 now, over 80. But in Quebec, we've just started that group going, and we don't currently have any Smith Manoeuvre certified professional accountants. Now, that being said, any accountant who is relatively adept at the profession should be able to understand, give them the book, right? Give them the book, let them read it, and suggest they become a Smith Manoeuvre certified professional, right? But it won't be that difficult for a professional. It's unfortunate that we don't currently have any accountants in Quebec. We're working on that, but the book to the professional is probably the best place to start.
Sounds good. Chris, do you have anything to add about, is there a special way you communicate the deductions?
No, I mean, if you are doing things correctly, then you should just be able to print off your line of credit statement for the year, and it's going to clearly total what the interest is, and you can deliver that to your accountant. It's going to be covered under the carrying charges on the tax return, and so that should just be your piece of paper that you need. So, provided you've kept things nice and clean with how you're handling the maneuver, it should be right off of your line of credit statement.
Awesome. So I'm going to try to bang through these real fast, everyone. We're going to send out a recording of just the questions as well. So if you do have to run, that's okay. Another person asked, but where are you investing so you don't lose money? I'll give my 2 cents first. And there's no, other than a GIC, there's nowhere that you can guarantee you don't lose money. And that's where the professionals come in, providing overlapping advice on where can you invest to minimize your risks and offset your risks with different pools of investments. Rob, Andrew, do you guys have anything to add on that?
Yeah, I'll just say that this is a discussion you have with a trusted advisor. What are you comfortable in? What do you understand? If you don't understand anything, what are you willing to research and understand? There's nothing guaranteed, like Keaton said. There's safe, there's risky, and this is not take our money each month and go to Vegas and put it on red. This is a situation where you're saving for your family's future. So you want to be conservative, look for growth. Don't take any high flyers, especially at the outset. Maybe down the road when you're already doing really, really well, take a couple bucks and have some fun, but consult a professional. That's the best advice I can give.
Awesome. So next question is, do cash value life policies qualify as an investment vehicle? That's either Chris or Rob.
They do not. CRA doesn't give you 2 kicks at the can. So cash value life insurance is growing tax-free. So, and in the same way as contributing to a registered fund like an RRSP or a TFSA, you're already getting tax advantages from those various vehicles. So CRA is not going to allow you to write off any interest when you are contributing to those. So again, that is the importance of understanding these rules so that you aren't offside with the investments that you do make and invalidate that interest that you're paying.
Amazing. Prime the pump. Can I use the available equity to put a down payment on a rental income property? Yes, you can. One of the most common sources of down payment for real estate investors is equity in an existing property. So you can typically borrow up to 80%. There are rumors of the rules changing, but there have been rumors for a long time. But as of today, October the 5th, 2022, you can. For the cash flow dam, if you missed doing last year's expenses, can we retroactively catch up by paying the mortgage this year? Chris.
No, deductions are all based on the calendar year basis. You could potentially amend your tax return from the other year, but it is based on the period that the expenses were incurred. So if they were from last year, then you would have to adjust last year's return.
So the big thing to remember about cash damming is that you're taking your gross revenue from an investment property or a sole proprietorship. You're taking the gross revenue before expenses, paying down your non-tax deductible mortgage on your home or a second property that's not tax deductible. Then you're borrowing to service expenses. So if the cash flow is already cycled, there's nothing to debt swap. But if you did have a lump of excess cash sitting around, there are other accelerators like a debt swap that you could use for this. So talk to professionals, but based on your situation, there's lots of angles to maneuver the Smith maneuver. Let's see. Can the cash flow dam be applied to rental investment properties, please? I'll answer this one real quick. Rental properties typically have tax deductible debt on them. They're investment assets. So typically the mortgage used to buy the rental property is already tax deductible. One of the most common questions I get is, I want to do the Smith maneuver on my rental. It is only for non-tax deductible debt, typically a second property or vacation property or your primary residence. Anything to add, anyone? Rob?
Yeah, I will say, so rental properties can be used to accelerate the conversion of your own mortgage, your principal residence. But don't forget that you also might want to look at what sort of financing you have on your rental property. Because if you're the type of investor who wants to access all the equity you can as quick as you can, having a readvanceable on your rental property as well means you can access that equity on a monthly basis and put it to work, rather than have to wait 2, 3, 5 years until a refi with all the pain and brain damage of doing a qualification and application, all that stuff. You get to that point, now your refi can access the equity. If you've got a readvanceable on your rental property, you have access to it as you want it.
Amazing. We have a question. How are you guys finding the impact of higher interest rates when we have current low mortgages locked in? Math's still working out very favorably. So I'll give one example, and I think the others probably answer as well. There are situations where I look at clients that, an example, cash damming is not beneficial in the short term. The cost of the tax deductible debt after they've paid down and reborrowed after their tax deductibility is sometimes still higher than the non-tax deductible debt. But it's also important to do an analysis of long term. Your mortgage is going to renew at some point. Then you're going to move to parity and it's going to be apples to apples. And this is where I really lean on people like Chris and Graham, the financial planners and the accountants, to look at the long term. The biggest thing though is you want experts. I've seen people doing cash damming, and there are secondary steps you can take to cut the cost of the debt long term. They're not taking them. And I kind of, hey, you realize you've been doing this for 7 years and it's actually cost you money because you're not doing the full strategy. They're not very happy with whoever's giving them advice at that point. But do you guys have anything to add?
No, I'm good with that, Keaton.
We'll keep banging on. What are the limitations of things to be mindful for the cash flow dam? It's higher carrying costs, especially if you don't have a net positive cash flow.
No, I think you kind of just addressed that, Keaton?
Yeah, it is important to know that when you pay down your primary mortgage and you reborrow, your overall payments can get higher. Now, there is a strategy you can use that we'll get Robinson to record a video on and send out, where the increased efficiency and the pay down of your mortgage can offset it. But if you use some of these accelerators, it can cause a net increase in your payments. There are tricks like calling your bank and saying, I've made a very large amount of prepayments recently. Can you re-amortize my mortgage to the natural amortization and lower my payments? If you have questions on that, reach out, we'll answer them because they are very case by case. For the cash flow dam accelerator, do we need to be incorporated?
No, there's no, in fact, it actually works easier if you're not incorporated. If you're incorporated, in fact, it's actually a lot more challenging, because every time you have flows of funds moving between the corporate and personal levels, you have a tax implication. Whereas a proprietorship and or a non-incorporation, CRA is treating as just the left and the right hand. You're the same taxable entity. So it's a lot more straightforward, in fact.
Rob, did you have anything to add?
Agreed. That's what I was going to say.
Perfect. My general advice is, if you're incorporated, no cash damming. I have seen miracles work by accountants, but that's Chris's side. Typically, when we're planning portfolios, if someone has no properties, we'll often look at the idea, even if they do want to incorporate, does it make sense to take 1 or 2 properties personally and then put the remainder in a corporation? It's very case by case. What if we use some of the HELOC money for other expenses? Does that make it non-tax deductible?
Yes, in fact, the rules are very, very punitive in that regard. For instance, let's say you have advanced $100,000 for investment purposes, and then you use that line of credit, you take 10 grand out to go for a vacation, and 2 weeks later you pay that 10 grand back. CRA's stated position is that you have paid off $10,000 of the deductible debt, and the new stance of that mortgage would, or that line of credit would now be 90,000 deductible and 10,000 non-deductible. So if you have any expectation of needing those for personal renovations or for any personal expenses, you should be dividing your line of credit into various tranches. In the same way, you know, if you want to be splitting your investments for incomes for tax or income splitting purposes, you know, you could have a tranche for your wife's investment line of credit, a tranche for your line of credit, and a tranche for any personal. I have 3 tranches for my line of credit. That's the way that we've treated it in that regard.
Yeah, and that's where someone like Keaton could come in and say, look, we're going to prep you for these potential events right off the bat. So again, you know, speaking to someone about who knows what could happen is very valuable.
I eliminate any mortgage product that does not allow multiple lines of credit and mortgage components at the same time. Typically, the minimum I shoot for is 3 lines of credit and 3 mortgages simultaneously on the same property. Any less than that, and you lack the flexibility to really optimize the strategy, or can find yourself backed in a corner. Can you explain debt swapping?
Yeah, basically, if I've got $500,000 of non-deductible mortgage debt, I have the opportunity to swap out bad debt for good debt by taking cash or by redeeming investments for cash. I'm swapping debt because I'm paying down bad debt and replacing it with good debt. So I'm swapping which side of the ledger, if you will, that this debt is on. So I can redeem investment assets for cash. Let's look at taxation. Am I going to pay too much capital gains? Does it make sense? Let's talk to Chris about that. But if it does make sense, I can take the cash, prepay, borrow back, and then invest again. And when you do invest again, if you buy the exact same investment, there are things you need to watch out for. And Chris would be able to talk all day long about that, superficial loss rules. But it's basically achieving the creation of tax deductible debt and reducing the non-deductible debt.
Amazing. Does the Smith maneuver work if you have more than one rental property? I think the person asking may misunderstand the strategy. The Smith maneuver requires non-tax deductible debt, typically on your primary residence or a vacation property. If you've got 2 rental properties or 200, that wouldn't impact it. But you could have 30 properties. If you have no non-tax deductible debt, let's say you rent your primary residence, there may be no strategy here for you. So you can still look at leveraged investing, but that's not the Smith maneuver.
And another answer, which may be that the strategy wasn't misunderstood, but maybe the question is, can I apply the cash flow dam, for example, using more than one investment property? And yes, this is where Keaton would say, okay, you're going to hit your prepayment allowance at such and such a point. We've had realtors as clients that had 5 investment properties. Boom, they were gone in less than a year. But they did have to pay prepayment penalties because they were prepaying by too much. Now, do you want to take on that penalty? It depends. That's when you do the analysis. How much is the penalty if I want to continue to prepay for the rest of the year?
Andrew?
Yeah, that's exactly what I did with mine, and I converted my debt in, I think it was under 8 years or whatever. But what I did was basically with my situation was I knew where the prepayment penalties were, and I maxed to those points and applied from the different property rental incomes into that, and it worked fine. But I mean, again, I had somebody that knew what they were doing, making sure that I made all the right moves for the tax man and for general accounting purposes. So, and he was a CPA, now retired.
What would you suggest for someone who has no mortgage on their principal residence and is using their HELOC to invest? Is it advantageous to get a new refinanceable mortgage to pay off the HELOC?
Well, I think you're the one who'd be able to answer this, Keaton, but it may make sense. If you've got a $100,000 balance on your HELOC that you've used to invest, hopefully you're deducting all the interest. But Keaton would step in and say, okay, what if we perform the Fraser finagle? It's actually a thing named after my dad. There's a possibility that your cash outflow could be reduced if you move it over to an amortizing component.
The best spread I've seen is we had one client where we were able to save 1.8% between their line of credit interest. We used a phrase or finagle, and we were able to cut the interest down about 1.8% while maintaining the tax deductibility. We set up a readvanceable product so they could maintain interest only payments as well, even though it was amortized. So if you're in that situation, let us know. With the Smith Manoeuvre calculator, can we apply these accelerators to prepay the mortgage super fast? But what about the prepayment limits are often 20%? Does this mean prepay anyway and also pay the penalties going over the 20% limit?
Yeah, when I was advising, we'd have clients regularly who in the 6th month, the 7th month of the year, they'd hit their prepayment allowance 20%. And they say, well, I can't do this anymore. I can't prepay anymore. I've hit my limit. Well, again, if you're in the right product, you can continue to prepay along with the penalty. If you're in the wrong product, you can't, even if you want to. So again, this is why it's so important to talk to someone like Keith. But the question is, call them up. How much is your prepayment penalty going to be? Because we would have people regularly, they've been prepaying their mortgage $3,000 a month. And then they get this, no, I can't prepay. I've hit the limit. Okay, well, let's find out how. Well, $110 for the next 4 months to continue to prepay by $3,000, $4,000. Were they willing to accept that? Absolutely, they were. Will you be? Maybe not.
One of the things I look at clients with prepayment privilege as well is, can you sustain it? If you can sustain the payment frequency you're making until the mortgage is gone, it leans towards it may make sense to do it aggressively. But if you're going to run out of cash, you're going to eat a penalty, 6 months later, you're out of cash, and all of a sudden you're not prepaying anymore, it often makes sense to wait. It's very case by case, but we do have some lenders that allow up to 25% of the original mortgage balance as prepayment every single year. I guess if you you live in Yellowknife, maybe that's not a huge number, but I think for a lot of us, that's still a pretty big, often 6 figures every year in extra payments. So it is situational, but more often than not, prepayment limits aren't a major concern. Someone asked if we can explain the difference between a HELOC and a readvanceable mortgage. Sure. A readvanceable mortgage is like a container that can contain HELOCs or home equity lines of credit and mortgage components, often multiple of each. A HELOC is simply a type of mortgage that is an interest only, often open line of credit that the balance goes up and down.
Well, yeah, and just to add to that, a lot of people think the Smith maneuver is, I've got an existing amortizing component, I'm going to slap a HELOC with the same institution, different institution, I can borrow from that to invest. Now I'm doing the Smith maneuver. Well, that's not the case, because if you get a 50K HELOC that's coming in second position, you can pull all that out and invest it, and you can claim the tax deductions. That's great. But now you still got a $300,000 non-deductible mortgage, which is going down, but that HELOC limit is not going up. So you can't access the new equity as fast as you're creating it.
So I should clarify, a readvanceable mortgage product, your line of credit or HELOC limit grows or increases as the the non-tax deductible mortgage component shrinks. For the Smith maneuver to work, does your investment have to beat the HELOC's interest rate?
Chris.
So do your returns need to be higher than your interest cost?
No, I mean, ideally they would be, because that's going to be a more positive spread, but it doesn't have to beat it due to the tax impact. So for instance, if you are in, and that's going to depend also on your tax rate. If you're in a 52% tax bracket, well then, and you're writing off interest at 4.5%, you could be break even with a 3% return on your investment. It just depends on, doing the math and individual situations. But ideally, you would want to find investments that could cross that hurdle rate.
Yeah, and to add to that, I always use 50% marginal tax rate just because it's easy numbers. But if I'm paying 5% on my HELOC, I'm at the 50% marginal tax rate. It's only costing me 2.5%. So I need 2.5% on my investment to sort of break even in this respect. But don't forget that no extra cash is coming out of my pocket to service that line of credit interest. So I can run a negative return for months, maybe years, hopefully not, but I don't have to come up with extra cash to pay the interest on that line of credit, because I'm not dependent on that investment sending me cash to pay the interest on that HELOC. So you've got time on your side.
Awesome. Someone asked a really, really complex question, which we will answer on the side. which is very personal. Someone asked the 65% loan to value limit. How does that affect the Smith Maneuver currently? So I guess I'll talk. There's two things you could be asking about. Lines of credit are limited at 65% loan to value. So $1 million property cannot have a line of credit with a greater limit than 650,000. There are ways we can lock in portions of the debt to essentially allow you to convert everything. And there are different ways things can be structured. But there's also a rule change coming in the winter, or I should say November, December of 2023, where the government is changing the way mortgages can readvance. Now, the exact changes are still a little bit murky, but if that's what you're asking and that's what you're worried about, know that there are already lenders that exist like Manulife that operate in a way that completely circumvent these changes, in the sense that if you take an 80% loan to value mortgage, they'll give you a 65% component that is readvanceable and a 15% component that's not. So at worst, these changes may impact the overall efficiency of doing the Smith Maneuver by about 10 or 15%. At best, they're going to be a non-change. And I suspect that they're more noise than anything else.
And I will just add, Keaton, that the Smithman calculator, the way it's designed is built on the Manulife One model, which is the most conservative way to do it. Up to 65% will readvance right away and 15% won't. Currently, you can get a mortgage where it's all going to readvance. It's going to stop later on down the road at 65 once that HELOC limit hits 65%. But the way the calculator set up is most conservative. So depending on the mortgage you're in, what you might see in the calculator, your actual results might be better. But the way it's set up is not all of the principal that is reduced each month is readvanceable. So that's why it's conservative. And as we saw in the little video there, we're still getting some pretty good results.
On the cash down, the rental income services my mortgage. Then I reborrow the same amount to service the debt. That means I pay interest on the rental with borrowed money. Are both interest payments deductible then?
Chris?
I'm unclear on that flow because
Yeah.
I mean,
It wasn't making a lot of sense as I was reading it.
I think, guys, that there's the question of, okay, I've got mortgage payments on my rental property. The interest is tax deductible because it's a business. Now I've got tax deductible payments on my readvanceable mortgage on the HELOC because I'm borrowing to invest in that business. Are both of these components still tax deductible?
yes, and one is going to be just deductible. It's going to be segmented and treated along with the rental expenses, and you're going to keep it kind of separate. And whereas the investment stuff is going to be disclosed separately. So, but both components would be deductible.
Chris, do you want to quickly touch on interest accrued servicing tax deductible debt? Like, let's say that you pay your line of credit with your line of credit.
Well, provided that you have met the rules of the deductibility in the first place, then that was confirmed by CRA, and that's kind of what allowed the strategy to move forward. That interest carried forward would also be deductible.
Section
21C, the Tax Act.
So interest accrued to pay
what
tax
says,
deductible interest is tax deductible.
Yeah, if I borrow money to pay tax deductible interest, because the interest I'm paying is tax deductible, the interest on the money I borrowed to pay that interest is also tax deductible.
It's almost like a riddle.
Probably the most confusing way to put it.
With the variable rate mortgages, how do we know how much money paying down the principal is available to invest?
Well, this is calculatable, like on the Smith Manoeuvre calculator there. It shows people how much they have to invest. Now, this changes over time. When rates change, they go up and they go down. But the reporting by the lender, your mortgage company, it'll show you how much new available credit you have. And you can run this trend. You can run an AM schedule. You can look at the trend and say, okay, well, rates have gone up. I'm going to drop my investment amount from $1,100 a month to $1,050, just to cover that a little bit, that increased interest expense. So it's not necessarily a game where we need to know down to the penny. It would be great if we did, but things change. So what we want to do is the very first months, typically the very first month when I pull money, I could invest that $1,100, but maybe I just let that sit. or pull it into my investment checking account and let it sit. I start that investment the next month because I'm not going to have it bang on each and every month as time goes on. So have this little slush in your Smith Manoeuvre checking account for that borrowing from the HELOC to cover any variance.
We'll do a side video in a week or two. Robinson actually has a really cool trick that he taught me on how to gauge if you're over investing, under investing, and it's really, really simple. So we'll do a video and explain how you can kind of navigate the pace that you're investing. What happens to your tax deduction when you sell your ETFs or investment property? How do you account for what part of the HELOC remains tax deductible?
Well, CRA deems that you should be, it all depends on what your use of those funds are. Either if you're reinvesting them, if you're just swapping into a new set of investments, then that's fine. If you are pulling them out of the investment fund and using it then for personal expenses, then CRA is going to expect that you're going to repay that deductible loan with them. The burden, CRA allows the tax deduction, but the burden falls on the taxpayer to prove that you have calculated it correctly. So that's why dealing with it is so critical, because that burden of proof relies on you. So if you've just sold your ETFs and bought other ones, then that's not a problem. It's all stayed within that investment portfolio, and you're fine there. There's no real issues. It's only if you're bringing the funds out to do other things, then you're going to have to maintain that. If you're liquidating so that you can buy a rental property, then you need to make sure that you're keeping the documentation for what that next use of funds is.
Yeah, one of the biggest benefits I've noticed with the Smith Manoeuvre certified professionals, as I've connected with more and more, and I have more clients working with everybody's involved in communicating, is how much everything gets simplified. The flow of money, the communication, the whole goal is to make things as straightforward and basic as possible. Rob?
Well, I was just gonna say that ideally we're able to hold our investments for a very, very long time. Whether we sell investments to buy other ones within the program, that's fine, as Chris just said. The use is still the same. It's just a different investment now. But ideally, when we hit retirement, we've got this large pool of investments, $1 million, $1.5 million, $3 million, whatever it is. Now I can draw income. I don't have to sell those assets to live off the redemption proceeds of the asset. They're large enough that I can generate income from the investments and leave them intact.
Awesome. Someone asked, does the Smith Manoeuvre calculator take account that your investments are earning income? What if they push you into a higher tax bracket, and how does that impact the strategy?
So often your investments you have to remember that the amount that you're investing is often less than the interest or the amount that is being created off of the investments is less than the interest that's being paid. Not only that, most of the investments are tax preferential. So even if you had, for instance, $10,000 of dividends coming in, but you had a $10,000 of interest expense, you actually would end up in a lower tax bracket because those dividends would be taxed at probably around 60–70% of the rate as if they were earned income. So you'd actually, even though you had $10,000 of additional income, you would still end up with a tax savings due to the fact that carrying charge, that interest, is actually designed to come off and be canceling out earned income, which is the highest taxable form.
I wasn't sure if Rob was going to speak. Not all returns are created equally. As an example, if you're earning interest income, that's going to be more punitive from a tax perspective than if you're earning dividends or you have investments that are growing in value, let's say a stock, but is not being cashed out. So I'm not the accountant, I'm not going to dive too deep, but the planner or the financial planner's job is to help you plan this out, to balance it out, to be as favorable as possible for you. It's not just dump your money in a bunch of investments. What happens if I move 5 to 10 years after implementing the strategy? And what happens if okay, let's answer that one first.
Well, people move all the time. And the way the program is designed, well, this is what the Smith Manoeuvre certified professionals understand, that a non-SMCP might not even have thought about it. But how do we, if we're moving, after we've implemented the strategy, we may not have even completed the conversion of our mortgage yet, but we need to move, we want to move. There is a way to bring over as much of the deductible debt that you have already created on that first home and place it on the second home that you're buying, so that you minimize the amount of any new non-deductible debt you have to take on if you're moving up, for example. So we can bring along the deductible debt. You don't have to start again if you move. If you refi to pay off other bad debt and they want to pay off the SM line of credit, how do you interpret that, Keaton?
Well, I think at the end of the day, if a bank wants you to do certain things that are not favorable, we want to look for another bank. At the end of the day, it's my job as the broker to work with you and your accountant to try to make sure that you stay in a position where you qualify. This is a very personal situation. I think, it's same if you lose your job or something and you're trying to refinance. I think the best thing is let's plan so you don't take on bad debt in the first case after you start implementing the Smith Maneuver. What is the first course of action I need to take? Changing my mortgage package or hiring a new accountant who knows these things? I would say it's a combination. Often the first step is clients will speak to me as a mortgage broker. We'll make sure it's a reasonable fit. We'll make sure that the option's there. Then I'll pull in people like Chris or financial planners like Graham, and they'll provide a secondary level of advice. If everything checks out, then off we go. Chris, Rob?
Yep, perfect.
Does the investment interest income have to go back on the readvanceable loan, or can I put it into a different account?
Chris?
Sorry, can you read the question again?
Does the investment interest or income have to go back onto the readvanceable loan, or can I put it into a different account?
So I'm assuming they're talking about the investment
Earnings.
proceeds, earnings.
Yeah.
Yeah. So I mean, once the earnings, that's part of that other strategy as well, is that those earnings can also be another form of the cash down. You can take those dividends and make those as additional prepayments and cycle the whole thing as well. So, ideally it would help accelerate those payments, and it all depends on what your use for those funds are.
But technically, if you want to take the income from your investment portfolio, you can spend that any way you want.
Yep.
You can buy something nice for your spouse. You can prepay your mortgage, reborrow, and invest again. It's up to you. Those are taxable earnings, so it's up to you what you do with them.
Yeah, remember the goal of the Smith Maneuver is to flow funds as efficiently as possible to minimize your interest income, minimize your taxes, and to maximize your long-term growth, usually by getting money invested sooner. So typically that's the lens that we look at things through. Someone asked, as a skeptic, what are the negatives or downsides of the strategy? Well, I touched on a little bit on mine, but if you do it really, really poorly, you can ruin your life. And that's where the professionals come in to put the bumper lanes. Maybe Chris, do you want to touch on return of capital investments? That's a common one where I see DIYers get themselves in trouble.
Yeah, I mean, the legal regulation says that you have to be investing for the purposes of earning taxable income. That's why it cuts out those insurance. That's why it cuts out the registered stuff. And so if you are intentionally creating a portfolio that's only creating return of capital, well, then you are intentionally trying to skirt the law. And so you're risking that deductibility. So, in that circumstance, again, it's the awareness and, putting yourself offside, because, CRA is looking, if you want to claim that deduction again, you have to prove that you've met the rules. The rules are you're creating taxable income from it. So, if there's a component that's return of capital, and it's just, you have a very broad investment portfolio and there's some return of capital that's occurring, then that's not a problem. It just depends on the levels of all of these things, right? What is the reasonable components of this?
Yeah, and even if there is a return of capital component, it changes things if you reinvest that return of capital component versus if you take it cash and spend it. It affects the deductibility, or it doesn't. It affects the ACB of the adjusted cost base of the investment, or it doesn't. So again, this is why Chris is so important. Now, the negative or other negatives or downsides, a lot of it has to do with comfort. We've been raised our whole lives being told by people older and wiser than us that you need to be clear title. You need to pay off that mortgage and own that house outright as soon as possible. And what happens there is, like I said earlier in the presentation, we plow all our money into the mortgage. We're clear title. We don't owe anything on it. And we don't have anything in savings because we've been pouring our money into our mortgage. And that's when we get into trouble. And what the strategy says is you're going to more or less maintain your total debt. You got a $500,000 mortgage. I want you to die with a $500,000 loan against that house, right? But it's going to be tax deductible for years and years and years and years. It's do great things for your tax bill. It's going to be able to generate this investment portfolio, which is going to be worth significantly more than the debt on the house. But people have a tough time accepting that. Even if I sit down and talk to them and say, I get it, I get it, I get it. We have had clients who 7 years in, they've completed the conversion of the mortgage, and ideally they're going to maintain their tax deductible debt so they can keep as much invested as possible, keep on investing and grow that portfolio. But Rob, we've completed goal number one, which is to convert that mortgage. We feel really good about that, but my spouse is having a hard time with the idea that we're going to continue to maintain that debt. And that's a discussion that you have with your spouse, your professional, because you can start to chip away at that tax deductible debt that you have. And you'll lose some tax benefit. And instead of investing $1 to earn 8%, you're paying off a debt that only costs you 2.5% or whatever it is. So financially, maybe it doesn't make sense, but sleep at night factor is important in life too, right? We need to be comfortable in our relationships. We need to be comfortable with our financial arrangement. But human behavior is a big part of this. If we decide to do this strategy, we have to commit to it. It's reversible down the road. It's reversible, and you can stop it at some point if you wish, whatever reason, but you need to commit and you need to do it. And if there is action you have to take on a monthly basis to keep this strategy rolling, you have to commit to doing it.
And
So human behavior is the big one.
And everybody's going to be different. Within my own personal journey, the only way that I felt comfortable enough was that I bought a whole life policy at the same time that was going to be big enough to pay off my debt. So then I had equity in my house that covered the debt. I had my investments that covered the debt. And now I had an insurance policy that covered the debt. So I had 3 times coverage, and the bank can get paid when I die, right? I've put it in the situation. And so I don't have to worry about if my investments zero out. I don't have to worry if my equity zeroes out. I put in another level of protection there, and everybody's going to have different levels of comfort on that strategy.
Yeah. Someone asked, is the Smith Manoeuvre calculator free online? No, it's not. And there's a link to purchase a calculator if you want, or if you send me a message, I can run through a demonstration of the calculator with you based on your numbers. Someone asked, Rob, does Smith Manoeuvre calculator account for the interest on the borrowings used for the Smith Manoeuvre? What interest rate is assumed in the calculator? What is the cost of borrowing these rates, saving? Anyways,
well,
last part don't make sense.
That's the fun part of the calculator is you input your mortgage rate, you input your borrowing rate on the HELOC, you input your investment, your forecasted investment growth rate, and you enter what's reasonable or what's going to happen, like on the rate side, what's reasonable on the growth side, and you come up with the result. And then you say, oh, okay, what if rates do this? And you plug that in. What if rates do this? Plug that in. Now you play with the growth rate, and you get all the results in real time. So yes, it accounts for all the borrowing, and you can play with the rates if you wish.
Someone asked, what if you don't have the cash up front to fund the cost of borrowing for the Smith Manoeuvre?
Well, that might have been asked before I kind of got around to answering that question, but there is no, I don't have to come up with money to pay for my initial borrowing to invest, if I'm sort of understanding this. Once I have the right mortgage, I'm set up so that money becomes available after I make my mortgage payment, and I pull that out to invest. The interest on that first month's borrowing, that's going to get taken next month, right? And serviced by the increasing efficiency of the regular mortgage payment. So I don't know if I understand that.
Yeah, I will say Robinson's answer took me almost a year to fully understand on this, but the interest owed on your non-tax deductible debt decreases every month you do the Smith Manoeuvre because you owe less. And there is a long version of the math to demonstrate, but the it can service itself where you just make your mortgage payment, but that requires executing things correctly and having the right mortgage product. So that's an advanced thing that talk about with a couple professionals if you want to go that route. I will add though, if you're worried that you don't have the money to fund the strategy, it might not be the right fit for you. Now, there's different people in different situations, but if that's not a case of, can I have it fund itself, but rather I'm really tight on funds, one of the biggest risks or downsides of the strategy is people being in a situation where they can't maintain it. Now, typically speaking, you can exit the strategy. You're not trapped, but if you're not in a reasonably healthy financial position, this probably is not the right strategy for you. This is not a magic cure-all. It has risks and it has rewards. And a big part of our job as a professional accountant, financial planner, and broker is helping you figure out, is this a good fit for you? What happens with the Smith Manoeuvre when you're capped out on the readvanceable mortgage and your mortgage is paid off? What are the next steps?
Okay, so this, I think, is saying when your mortgage is converted, what do you do? Well, you could maintain that deductible debt. And typically there's going to be a discrepancy when you've converted $500,000 of non-deductible debt to $500,000 interest-only line of credit. Maybe the rate on the line of credit is a bit higher than what you're paying on the amortizing loan, but because it's interest-only and not principal and interest, the amount that you pay to service that interest-only line of credit, there's a good chance it's less than what you've been paying in monthly payments for the past 18 years, 10 years, however long you've been going through the conversion process. So now the difference between what you have been paying with P&I payments and what you're paying with the interest-only payments can get invested directly. And you can maintain that tax deductible debt, keep on investing, and enjoy the tax deductions and the growth. Or that difference, you can use that to pay down the principal on that line of credit gradually over time. You can, if you want, sell a big chunk of your, you got a $900,000 portfolio, a $400,000 deductible line of credit. If you want, sell a bunch of investments to pay off that deductible debt and be a completely clear title, but still have $500,000 of investments that you wouldn't otherwise have. That's a decision you make at that time.
I'll quickly add, guys, we're about halfway through the questions. There's another 40 to go. So if you're feeling anxious or you got to go or it's getting really late, feel free to leave. We're going to send it a recording. That being said, at least for myself personally, I'm going to stay till the bitter end as long as there's someone here watching this. So if you guys are enjoying this, feel free to stick around. That being said, Rob, Chris, Andrew, if any of you guys have to run, I do get it. It is getting late. What is the best way to educate my accountant about this strategy? Chris?
I'd say the book. I mean, that's going to illustrate, like, the illustrations in the book and the language. The accountant should be able to, follow along from what that purpose is. So that's going to be, if you're wanting to stick with your accountant and train them, then give them the book, make them watch videos.
Or they could take the SMCP course and become an SMCP themselves. You can always suggest that. But Chris is absolutely right. The book's the first step.
I will add really quick, think of accountants like doctors. If you have a really, really bad car accident, you probably don't want the radiologist driving by the accident. You'd much rather the ER doctor. Accountants are very qualified, but I can tell you as a professional that works with investors, not all accountants are created equally and not all specialize in these kind of more nuanced strategies. Like, they may not be familiar with corporate structures or real estate investing or the Smith Manoeuvre. And my best advice is, if you're checking out a professional, do not ask, are you familiar with the Smith Manoeuvre? But rather ask an open-ended question. Hey, Chris, when you're trying to implement the Smith Manoeuvre, what's the best way to invest into the TFSA with the borrowed money? That's an example. Now, it's a trick question. You can't borrow into your TFSA and write off the interest. So if they try to answer it, it's wrong. Since this leveraged debt investing, how do I reduce, mitigate risk? And what are the preferred vehicles?
Use a professional, invest in whatever you're comfortable with after a discussion with a professional. That's the best advice that I can give. Professionals are there for a reason. Accountants, investment advisors, mortgage brokers, is because they can do that specific job better than 99% of the general population can.
Awesome. Ooh, someone's asked a hot question. What are you getting out of this by sharing the Smith Manoeuvre? Well, I'll go first. I'm a younger professional. I won Rookie of the Year across Canada for Dominion Lending Centers. I hit top 2% of brokers in my second year. I'm by no means in a position where I need new clients, but I am ambitious. I'd like to grow my business. One of the reasons why I work with investors and the Smith Maneuver is it's not all I do, but I want to grow my business and I want to demonstrate ways that I'm different and that I put time and energy to learn new skills and to really be the best at what I do compared to people who just do regular mortgages. Anybody else want to share?
This is an advertising channel or a sales channel for me. Accountants typically aren't out there advertising. So therefore, if we want to grow our firms, then we need to get in front of new clients, right? And demonstrate our skill sets. And so, either I'm doing consulting or I'm bringing on new clients. That's my role for or reason for participating, as well as being able to, know new strategies to benefit my clients, my existing client base. That's why I got into it in the first place.
Awesome. Rob, sorry.
I was going to say, as a poster child for this program back in the days of Fraser and his book and CD-ROM that I still have, when it wasn't near as organized as it is now, it was an amazing system that worked for me. Being an investment realtor, I'm very analytic, and not all realtors have a great reputation out there these days. And I believe that it is in our best interest to serve our clients the best way we can by building those relationships. And this is another tool to help me build a relationship with my client so that I am helping them build wealth in ways they may not be aware of. So again, it is to a degree a sales channel, but really it's a system that I know works when it's worked properly with the right people in charge.
Awesome. Rob, the next question doesn't really make sense to me. Does that one make sense to you, or we'll skip it?
Oh no, well, it ties into the question that we just had there. Basically, it's how do I get paid? Or what do I get out of it by sharing the Smith Maneuver? So two questions with the similar bent. My goal is to make sure every Canadian homeowner coast to coast is aware of the strategy so they can research it, look into it, and implement it if they decide it's for them. It is not easy out there in Canada. It is very difficult. It's not getting any easier. And as far as I'm concerned, a financially stronger Canadian is a financially stronger Canada. Now, I'm not doing all of this for free. If Bill in Halifax goes and does the Smith Maneuver, I don't get paid for that. The way I make my living is because the Smith Maneuver certified professionals in this network have committed to learning, becoming an expert in order to help promote this strategy and implement it for Canadians. And in order to remain in the network, they pay me. So Bill, Mary, Jane, they go and implement the Smith Maneuver. That doesn't affect me. Well, I got book sales, calculator sales, all that sort of thing. But nobody implementing the Smith Maneuver pays me.
Awesome. How likely is my current mortgage company to be able to work with a readvanceable mortgage? So it depends. There are some situations where people have products that we can port the product to a readvanceable product if it's not. So situationally, if you don't have the right thing, I can help you set it up. That's something that I do for free and don't get paid on. And that's fine. But it really depends on who you're with. And that's my job to look at where your loan is, how it's structured. Does it make sense to change it? Is there a way to be able to do the strategy in maybe a modified way for a period of time? And that's where I come in. They also asked something about their financial situation remaining the same, but I don't understand that aspect. So if that's your question, please reach out and clarify it. Am I correct in understanding that the interest on the money taken from the line of credit is tax deductible, not the actual principal extracted?
Yeah, the deduction is only occurring on the interest. You are redeploying that principal, right? That's what you're using to invest. So you're not getting a write-off for that principal, right? You're buying assets with it.
Chris, a quick question. Let's say I borrow money to pay a mortgage payment on a rental property. A portion pays the principal and a portion pays off the debt. Is there any issues there?
No.
Perfect. Someone also asked, are you able to add a HELOC to your existing fixed mortgage? You're required to have a re-advanceable first. Once again, it's case by case. It depends on your lender and your product. There are a few ways that we can get someone into the right product if they're with a big bank, but sadly, you got to talk to me or at least give me details for me to give you a specific answer. It is very case by case. Can a variable rate work with the Smith Manoeuvre? Yes. It has the potential to maybe magnify some of the downsides, and it's important to make an educated decision on it. But I would say a reasonable percentage of people that do the Smith Manoeuvre went variable. What is the ideal time to pay off the HELOC? Rob?
Yeah, again, we've kind of addressed that. You can die owing that money on the HELOC and just enjoy the growth on the investment portfolio that was generated from that borrowing. You can pay it off at any time. You can pay it down bit by bit. You can pay it off in full. But ideally, you're going to want to wait until your conversion process is complete and then have that discussion. Is where am I now? What am I comfortable with? Am I comfortable maintaining all of this debt? Do I want to knock it down by half? Do I want it all gone? But at least get that conversion completed.
Yeah, personally, I prefer the moment it's fully converted. If you're on track to exceed what you need, deleverage. But there's different takes on it, and it really depends on your personal situation and what your goals are.
Yeah. Similarly, if you go into retirement and your income has fallen significantly, you might not need the larger write-off, right? That's not going to have that same amount of value if your tax bracket has changed. So again, you would look at what your situation is and you make a decision at that point.
What are some common questions from the CRA if they request to review the eligibility of our claims for interest deductions?
Full paper trail. It's up to you to prove it. So
What did you do with the borrowed money?
Yeah, and so the problem in that regard, and that's part of, again, the do-it-yourself process versus accountants, is that let's say they ask you in year 7, they question the interest deduction in year 7, you might have to go back the entire trail to show those original funds 7 years ago. So did you keep those 7 years worth of paperwork? I do as part of my files, because I know that they're going to want to see that original deployment of capital, right? So things like, oh, well, I shredded my old tax returns after 7 years because that's all I needed to keep. Well, if you were running the strategy for 20 years and they ask about it in year 20, you may have to go back all 20 years because it's up to you to prove.
Awesome. So how simple is keeping the paper trail, Chris, from your perspective?
If you're doing it right, it's very easy. You should have a very clean line of credit, and you should have your clean, clearing account / investment account, and then your investment portfolio. So really, that's the full sequence of events, right? You see the funds being advanced from the line of credit into the clearing account. You see the payments coming back, paying that off. You see the transfers into the investment portfolio, and the investment portfolio tracks that down. So you have a complete circle. So it's just those 3 sets of documents.
Awesome. So someone asked, can you use the proceeds of the Smith Manoeuvre investment portfolio to further pay down the primary mortgage to create more borrowing room in the HELOC?
Yeah,
no, you're not.
That's effectively the DRIP accelerator. So I've got dividends coming in from my investment portfolio. I can take the cash, prepay my mortgage, pull that money back out, and then buy the exact same stock or a mutual fund or buy something different.
Someone asked about getting in touch with yourself, Chris. What is the best way to get a hold of you?
They can email me at chris@harrisonltd.ca, or alternatively, I was a member, in LinkedIn. If you search for Chris Harrison, then you're going to find me there as well.
I'll send everybody your contact details along with when we send out the schedule of the upcoming events.
Sure.
Is it smart to reinvest your positive cash flow back into your mortgage payments? So I think this is the same question over again. Yes, if you have profit from your investments, one of the things you can consider with it is paying down your non-tax deductible debt and repeating the cycle.
Yeah, and if you're doing the cash flow dam and you're cash flow positive, $3,000 in revenues, you can prepay your mortgage by $3,000, pull $3,000 back out. But if only $2,700 is needed for the expenses on that property, then 300 can go into some other type of investment if you want, securities, for example. Or if you want to keep that $300 to supplement your living expenses, you get 3,000 from the renter. Just take 2,700, prepay, borrow back 2,700, service the expenses. Keep that other 300 in your personal checking account for groceries.
Does the Smith maneuver work on multifamily rentals? You can cash down with multifamily properties, but once again, the Smith maneuver is focused on non-tax deductible debt. You do not implement the Smith maneuver on tax deductible debt on a rental property. What are the rates for hiring all the professionals, accountant, mortgage broker, lawyers in order to do Smith maneuver? Well, I'm free. The banks pay me directly. That's why I like my job.
Beat that, Chris.
Yeah, exactly. And then in the same way, your investment advisor typically gets paid, every investment advisor has different rates. And in the same way, I have, it all depends on the services, right? If you want, the tax returns are going to start at, well, again, it's all context specific. Are we talking, is there rental properties? Are we doing the cash flow dam? Is it straightforward? Do you have an inch thick pile of investment slips? It's going to be very specific, and so that's part of that conversation to have.
Everyone will get your contact details, Chris. They can contact you and get their situation.
I found that most people think CPAs are more expensive than they actually are, and I'm not talking from when you factor in the savings, but it's every CPA charges a different amount, but they're not as expensive as divorce lawyers. Don't worry, folks. Someone asked on the investment side, can you invest into bonds or GICs to do the Smith maneuver?
You can. That's going to create taxable revenue. That's going to create the highest form of the interest that is created off them is not going to be tax preferential. And you might have a hard time overcoming the hurdle rate of the interest that you're paying to borrow. So those would be potentially downsides of it, but they're perfectly valid investments to consider.
I have seen people, sorry, Rob?
Well, I was just going to say maybe a portion, if you really wanted some GIC stability, maybe just a portion of the portfolio, but you're earning such a low rate on that GIC, it doesn't really make sense.
Yeah, the math probably is not going to work.
Yeah.
Okay, so Chris, what ritual or voodoo do you have to do to cure a contaminated line of credit? So that would mean non-tax deductible and tax deductible debt mixed.
You start over. I mean, it all depends on your level of risk, right? There really isn't a way to undo it properly other than kind of cycling checks, fully paying it off, right? Restarting if you've contaminated it. Just because of the way that CRA has deemed those payments. Unless that line of credit hits zero again and you restart it.
And the crazy thing, people, is I have had clients that have come to me and said, my accountant has told me it is okay to cross-pollinate the tax deductible and non-tax deductible debt. Make sure that you chat with people that know what you're doing.
Yeah, that's the point here, is there are so many people who don't understand, even though they're professionals. They may be good at what they do in this respect, but maybe they haven't brushed up on this aspect of their profession or whatever the case may be. That's why it's so important to use professionals. Now, we have had clients in the past, they say, well, I got a $30,000 line of credit balance. And I know for a fact, $5,000 of that was used for, I bought a new boiler for my house. The rest is investing. I've got things to prove this. Well, we took that to the accountant and the accountant broke it down and says, here's what we got. You can take a bit of that line of credit balance and stack it on your existing non-deductible debt, right? As long as the math can be justifiable. We've accounted for.
You can adjust, right? You look at the bottom of your interest statement that you are going to, print off for the year. You paid $10,000 of interest. You don't have to write $10,000 on your tax return. You could write $9,500 on your tax return as far as claiming the deduction. If you don't want to clean up that line of credit, but if you want it to be completely pure, then you would do a check cycle, repay it, readvance, and go from there. But there's nothing saying that you would have to claim every dollar of the interest that was created off of that line of credit if you knew it was impure.
Someone asked, no, this is a question for you, Chris. Is it an issue to do the Smith maneuver and to cash dam if you have a secondary suite in your primary residence?
Yes, because there's a personal component to it. So that's the same with proprietorships as well, is if you have to be very careful of which expenses you are running through, that there isn't a personal component, because you can risk the deductibility. So in the same way, only 50% of, for instance, the basement suite occupies 50% of the residence. That means that you're only writing off 50% of that revenue. And so you are going to see some challenges there. So it is not ideal to use, suites within your own property to cash flow down.
And there's the question of, is the revenue from my renter actually supplanting me having to come up with that cash flow to make my regular mortgage payment, or am I taking that as cash and I can do whatever I wish with it? And how much of your principal residence mortgage interest do you write off, because how much is the rental suite? 50%, as Chris was saying. So this is where, when people try to do their own tax returns, some challenges can arise.
Yeah, I don't think I acted in good faith goes very far with the CRA. Chris, do you want to quickly touch on people building coach homes on their primary residence as well?
Well,
or is that too loaded of a question for late?
Yeah, I mean, and this is one that is a very loaded question, because there are different different accounting firms that have taken different positions. CRA's the biggest actual worry is less about the Smith maneuver and more a matter of you could lose your primary residence exemption. And there is going to be court cases going forward that will have people blown up over that, especially if, for instance, you have a basement suite that's taking up 50% of your main property, and then you build the coach house on your property. All of a sudden now, maybe 65 or 66% of your property is being used for income purposes. Well, now the primary residence exemption says that the majority use of that property has to be personal. So if you breach that by the fact that you put on a coach house, well, then now you're not only questioning potentially the deductibility, but you might lose and create a taxable capital gain when you actually go to sell. There's also a huge amount of GST rules. Small suppliers, you can be deemed as a developer. When you're doing that, there's no end of issues that are coming up, because the Tax Act, coach houses weren't really all that common when it was first created. So there are going to be some tears shed in the next number of years as CRA prosecutes or sets some tax rules through court.
Sorry, I couldn't resist throwing you the curveball. I figured it'd be an amazing question to show how technical you are, and in my opinion, better than a lot of other accountants you are. As you take out the money from your line of credit, how are those new payments handled? Does this mean you're paying for the mortgage and line of credit? Situationally, but Rob, do you want to?
Well, I think we just have to go back and watch that section of the presentation. It's the increasing efficiency of the regular mortgage payment takes care of that. So have another review of that, and that should be understood.
Okay, very long question that doesn't make sense. I'm going to skip that. Does RSP have anything to do with
actually, Keaton, I'm reading it too. And I
feel free to answer it.
Yeah, okay. In your example where you took $3,000 rental income to pay down your personal mortgage and then reloan the $3,000 to the RE Corp, firstly, it's not a corporation, it's a proprietorship. Then the $3,000 interest is deductible to the Corp, but then it has to be recorded as income to you personally. So that's left pocket switching to right pocket. In rental real estate, the interest is already deductible. So to me, Smith Manoeuvre works with principal residence, not rentals. What am I missing? You're not really missing anything, because it does work with principal residence. It doesn't work with rental properties. If I'm doing the cash flow dam or not, I'm getting rental receipts of $3,000, taxable, Smith Manoeuvre or not. Instead of paying expenses on that rental property, first, I'm going to prepay my bad debt and replace it with good debt, and then pay the expenses on that rental property. The borrowing of that $3,000 a month from my HELOC to then service the expenses on that rental property is tax deductible because I'm borrowing into my business, borrowing to invest in my business. The interest payment on that rental property mortgage is also tax deductible because that initial borrowing went to invest in a business, which is buy a property.
Awesome. Do RSPs have anything to do with the Smith Maneuver? No. Anybody have anything to add to that?
Well, a lot of people will say, well, it doesn't make sense to do the Smith Maneuver until you've maxed out your RSPs, your TFSAs. We can't forget that when we're taking our after-tax dollars, deciding what to do with it, I can contribute $300 a month into an RSP or a TFSA, and that's great. But maybe I haven't maxed those out, my contribution space. I start doing the Smith Maneuver, I can still continue to contribute that $300 a month, but now I've also freed up $1,000, $1,500 to invest in a registered investment. So you can do both because this is new money to go into registered, can't go into non-registered investment, can't go into registered on the Smith Maneuver side, but it's new money. I can continue to take my after-tax dollars and contribute to the registered components.
I think, Chris, you might like this question. Is it possible to put funds into a cash value insurance, like the infinite banking concept, then put it onto a mortgage, then put it into an investment? So I think, is there any way to include infinite banking concept or certain life insurance strategies with the Smith Maneuver?
They don't directly tie in. There isn't, because of all of the different deductibility things. There are ways to, for instance, marry the two projects together, through after-tax funds. For instance, you've done the Smith Maneuver, it's creating dividends, and rather than putting those dividends back to the house, you deploy those dividends to help pay for the insurance policy premiums, right? You've redeployed it for a different strategy because those dividends that were created were yours to use. So there are ways to do it, but they're not going to directly link together.
If someone has a corporate structure, is there more flexibility or more angles that these strategies can be looked at?
Well, typically within infinite banking, often that's held up at the corporate level, like that there's a big tax advantage. Well, there's some big advantages to having those cash value policies at the corporate level. So then now we have a whole other level of complexity because the Smith Maneuver is cycling things at the personal level, whereas the infinite banking is largely happening at the corporate level with corporate after-tax funds. So they end up being quite distinct.
Awesome. What is the best way to start off with real estate investing, such as buying your first real estate? Who should you talk to first? Maybe I'm selfish, but I'd say whether it's your first home or your first rental property, often the broker side's a good place because many people who want to do it are not in a position yet. A lot of what we do is building the plan. So a lot of what I do is helping clients that are 2, 3, 5 years out from actually taking action and positioning it so that you can get there faster or more efficiently. But anyone else have an answer?
Well, I also think it comes back to what is their plan? What are they trying to do? Where are they going? What is their income capabilities? Again, it goes back to about them first. You're going to facilitate the how to a degree and make sure they're set up strategically. Are they buying just one property? Are they planning to buy 5 properties, 10 properties? What are they trying to do? Speak to you, then they start to, I'd say, work with somebody that is going to help them work on that plan.
Next one's for you.
Go ahead. That's it. Sorry.
Next one's for you, Chris. Can U.S. rental properties be used in the strategy? Like, how does cross-border stuff look? Can you cash down with U.S. properties, as an example?
Yeah, I mean, U.S. properties are still taxable fully under your Canadian tax return. You're required to be declaring that income. So from all worldwide sources. So you might have additional tax obligations in the US. And so if you're using up all of the cash, consuming it, then you might have, depending on the situation with the IRS, then you might have some issues where there's not great integration with, fully utilizing that cash flow down. But for instance, I'm not an expert on cross-border stuff. It gets very complicated very quickly, but you're declaring your worldwide income. So therefore it would be applicable for your Canadian return.
And I assume it's much more straightforward to borrow on your home in Canada and buy US properties.
Well, generally, that's the biggest issue is actually qualifying for financing in the US, because you need US source income to qualify. So Canadian buyers are typically leveraging Canadian funding sources to buy down in the US.
How does the Smith Maneuver work with house hacking?
Not sure what house hacking is.
If you rent your rooms and stuff, I don't know. I'd say it's a house hacking is typically renting rooms and other ways to drive revenue. I'm going to go with it's a gray area, and you're going to want to run your specific situation by your accountant.
Well, also, again, if they're too much commercial activity in their house, then they may, again, as Chris pointed out, have capital gains issues, all sorts of things, like because of the use of their house instead of being personal.
So Chris, someone's asking if they invest in an ETF that has a return of capital model, is there a simple, clean way to adjust the cost basis?
Well, the cost base, the investment manager should be recording the cost base. It should be just updated in your investment portfolio naturally. Otherwise, but there is on the tax slip that gets issued annually, it tells you the dollar value of that return of capital, and depending on the tax software you're using, mine calculates the cumulative return of capital that's occurred from that history of that slip.
Awesome. Situationally, does it make sense to withdraw RSPs to pay down the non-tax deductible debt and then reinvest it into non-registered investments?
I think that would be highly, highly specific to income levels and all of that sort of stuff, because you're creating a very large hit to your income for a one time, and then you're getting the tax deductions over the course of a large number of years. So they may be disjointed things. For instance, you're taking out $20,000, so you're having a $20,000 addition to your income, and you're repaying it. Well, you're re-advancing it. That might create a $20,000 debt, but even at 5%, now we're talking $1,000 of interest over an entire year. So you would recover that tax hit. It would take 20 years, right? So it would be very, very situational to what's going on for someone.
I've seen situations where people maybe quit from being very high income earners. They're starting a business. They plan on making little to no money for 2 or 3 years. Then they expect to earn, let's say a 50% tax bracket and retire in a 50% tax bracket. Situationally, guys, it can make sense, but this is high level black belt stuff for your accountant and your financial planner. How does Smith Maneuver work if you're selling your primary residence? Can it be transferred to a new primary residence? Rob?
Yes, it can. Your SMCPs know how to handle that.
If I borrow on a rental property HELOC to make a lump sum payment on my primary residence mortgage, then reborrow that money from my primary residence HELOC to pay back my rental property HELOC, does that qualify as Smith Maneuver?
No.
I think short answer is no.
The test is, what did you do with the borrowed money? You got a rental property, you're borrowing from it. Common mistake is people think, well, it's secured by my rental property. It doesn't matter what I do with this borrowed money. It's still deductible. That's not the case. What did you do with it? I borrow from my rental property. I make a payment against my own principal residence. I have just paid down non-deductible debt. Therefore, all I've done is transfer non-deductible debt from my principal residence over to my rental property. Chris, thumbs up or thumbs down?
It's exactly right. It's the same with people who have a paid off rental property and they take a large mortgage against it to buy their next primary residence. Well, just because it was secured by the rental property doesn't mean that the funds were used for investing purposes. And now you have a non-deductible debt that's just tied to a rental property.
How is a vacation property applicable to the Smith Maneuver? Is it not just applicable to a primary residence? Can you do it on 2 properties?
Yeah, as long as you've got non-deductible debt. I got a principal residence, I can get a readvanceable and Smith Maneuver my principal residence to convert that debt. I've got a recreational property up at the lake. I don't rent it out, it's my family's. It's non-deductible debt because I borrowed to buy that property to consume. Therefore, I can get a readvanceable mortgage and convert that mortgage as well.
Robinson was just talking about debt swapping with investment funds. Do these funds need to be liquid or can they remain invested in swaps still?
Well, the mortgage lender is going to want to be paid with cash, right? Maybe in the future they will accept Bitcoin or something like that. I don't know, but if you're going to pay your mortgage down, then the lender wants cash. So I got $10,000 in mutual funds or stocks, sell them for cash, pay down, borrow back, buy the same thing, buy something different.
I presume the CRA would want to see the money used to put into an investment as well. And if you never actually sold the investment, then there wouldn't be a paper trail from the line of credit or whatever you borrow on to the investment.
Exactly.
Also, can they remain within RSP, LIRA, or TFSA structure? I think the short answer is no. No registered money in the Smith Manoeuvre, oil and water. If you use a secured line of credit against a rental property to invest, is that tax deductible?
Again, what was the purpose of the funds? Or the use of those funds?
Does having this much revolving line of credit debt hurt our debt service ratio or debt coverage ratio with banks for future borrowing? Short answer is yes. And that's something that as an investment focused broker, I account for. There are tricks and strategies though we can do to wash it out. One example is calling your bank saying I've made significant prepayments, please lower my payment. The Fraser finagle is another way that we can try to bring the overall debt servicing down, but it is something you want to be aware of. Rob, does Butera's question make sense to you?
Yeah, this is a Smith Manoeuvre calculator question, and the way that the calculator is designed is I can reduce or increase the amount that I accept from the lender. They may want to say, hey, I'll give you 80% loan to value, but if I don't want 80%, I only take 70% loan to value. That has an effect on how much of my balance on my readvancing component and my non-readvancing component. The more I accept as total loan, the less better off I am as to how much I can initially borrow to invest.
Someone asked, my current loan is at 80% loan to value. I came across some money and will be able to pay off my mortgage. Will the loan to value be reduced to 65% loan to value for the HELOC? If you've got a $100,000 home and you owe 80,000 and you come into an $80,000 inheritance, if you pay it off in one go with a more readvancing product, yes, it's going to get capped at 65,000. But there are ways that we can position it where we might do it in two pay downs, where you could end up reborrowing 80% the tax deductible way. If we borrow to invest in dividend stocks as part of the Smith Manoeuvre strategy, is there a rule on what we are allowed, not allowed to do with the dividend income to ensure the debt remains tax deductible? Or can I use that cash to personal things?
Yeah, I think that was answered before. You got income from your investments, you do what you want with them. You either prepay your mortgage, use the drip accelerator, make car payments, because income from your investments, as long as it's taxable, you can do whatever you want with them.
Chris, this one will be a good one for you. Can you use the Smith Manoeuvre to buy a company?
You can. That's most of the funds that I did. In fact, I bought 2 companies with it. So again, those companies are how I pay myself. So it's very clearly creating revenue.
Someone asked, can I pay the interest on my HELOC with HELOC funds? Yes. How are each of you compensated? We already answered that earlier. We get paid to do mortgages or our relative services. Does that make sense to you, Rob? The next one. I'm going to go with no.
Oh, that's the question we've already answered. Are the funds paid still tax deductible? I think he's asking, if I borrow to service deductible interest, do I still get to deduct the money that I borrowed to pay the interest with? And yes. I'm looking at Henry's question there.
Yeah. Someone asked a very elaborate question about cash damming. I would say that I'll give you an example. If you cash dam and you're readvancing mortgage product to set up with certain lenders, the principal pay down you make. So when you cash dam and you take your rent and pay down your mortgage, it might not show up on your line of credit for 30 to 80 days. Instead of answering this question, I'm going to say that if you want to cash down, talk to experts and make sure everything's going to work. Because in this case, it's very much about how to flow the money. But cash damming is a very simple and straightforward strategy if set up correctly and you know what's going to happen. It is also a really quick way to be in a 911 when the money's not there and you got to pay your mortgage. You see anything in there you want to answer, Rob?
No.
My spouse has a business funded by expensive government loans. Can I utilize my equity to pay off the expensive non-deductible loans and have her make payments back on the equity line?
That seems to me to be a simple refi question, right? If they got the equity, they could refi to pay off the government loans. Now they've got non-deductible mortgage debt and Smith Manoeuvre.
I would assume though government loans for purposes of starting a business would probably be tax deductible. So I imagine that you would be able to pay that out in a tax deductible way.
Right.
So yes, if you have expensive tax deductible debt, we can look at ways to bring the overall cost down and how to best position it.
Debt preservation.
Lots of people want to talk to you, Chris. Anyone who wants the free book, I'm going to be going through all the emails and sending them out. But if you're worried, just send me another email and I'll make sure you get one.
I'll take this one. Does it make sense to take funds out of a HELOC and do a lump sum payment on a primary mortgage and then take the funds that open up on the HELOC to invest? Again, what did you do with the borrowed money? If I borrow $10,000 from my HELOC to pay down $10,000 of my mortgage, yes, that opens up another $10,000 on a line of credit. I pull that out to invest. I've got $10,000 in non-deductible debt, that first borrowing to pay down my principal residence, which is not deductible, and $10,000 of debt that is deductible. So no, does not make sense.
Yeah, you just corrupted that line of credit.
Yeah.
Can I refinance my current primary residence, put equity towards a new primary residence, then convert the old home into a rental and implement the Smith Maneuver?
Yes, when you move, a change of residence is considered to be a deemed disposition. So when you move out, it actually is considered to be sold at that point in time. And so if you had an existing mortgage, the problem in that regard would be if you advanced funds for your new primary residence, well, then obviously that's not going to be deductible. But any other debts could be deductible for that new rental property, or what would be considered the new rental property.
We made it. We are at the end of the questions. Thank you all for sticking through it with us.